Hello and welcome to Lipper's Fund Flows Insight Report. I'm Jeff Turnahoy. For the weekend of July 10th, 2013, the investment community seemed to answer the question of what will the Fed do next when a lot of the tapering concerns seemed to go away after Ben Bernanke made a few clarifying remarks in order to calm investor fears that tapering was imminently due. For the week, let's take a look at our macro groups and see where the activity was. Obviously, equity and fund investors responded well to this clarification. They added about $3.4 billion this week. Taxable bond fund investors, not as certain. They only added about $219 million net to their accounts. Municipal debt funds, they still have a tough time of things. They had about $1 billion in outflows, while money market funds saw about $22.9 billion in inflows. Well, after it was all said and done, I think the community felt that the tapering program would not commence any earlier than September and likely not until 2014, and that was certainly enough to get investors back into a risk-on profile, at least when it comes to equity mutual funds. Let's take a look at the equity numbers this week. That $3.4 billion was pretty good. It amounted to about 212 basis points in performance as well. So that put a lot of major indexes near record highs for the week. Some new records were set as well. As I mentioned, there was a risk-on trade for mutual fund investors. That meant plowing money into emerging markets. They saw about $392 million flow in this week. Not far behind were China region funds. They had about $253 million in net new money come in. At the other end of the spectrum, interest rate sensitive trades and sectors, I should say, saw outflows, albeit not very much. Real estate funds was the worst of it. They saw about $212 million in outflows. When we look at the ETF side, we'll see a similar trait there. In fact, let's just turn our attention right now to equity ETFs. They saw about $8.4 billion in net new money this week. It's a very good showing. One of their best weeks since early January, harkening back to that New Year euphoria. With about 2 consecutive weeks of inflows, things are hitting on all cylinders for equity ETFs. The SPY S&P 500 ETF saw the lion's share of inflows this week. They took in about $5.5 billion in new money. The Russell 2000 ETF IWM was a little bit farther behind, but still very respectful with about $1.5 billion in net new money. The other end of the scale was not very good for gold, GLD. Investors took the hint from the Fed that things were not going to get any worse. Inflation still looks under control, and tapering, at least we're talking about it now, and that was enough to keep pressure on gold prices. GLD saw outflows of about $1 billion. Again, interest rate sensitive plays tended to show the worst. As mentioned, GLD with about $1 billion in outflows. At the other areas that were suffering for outflows on the equity ETF side, commodity-related ETFs also saw pretty dismal outflows this week as well. Well, the next group that had some good inflows in spite of things were taxable bond funds. They had about $219 million in inflows. This is certainly better than the way things looked a few weeks ago. Perhaps they've turned a corner on the sentiment play. Is the worst over, in fact, is the frequently repeated question. They had flat performance this week. That probably kept some investors on the sidelines. Loan funds continued to be dominant as far as flows go on the rankings. However, with $712 million this week, it's a little bit less than what they've seen recently. So investors still concerned about interest rates, although still putting money to work in loans. Double line and other U.S. mortgage plays. It was double line really who caused the U.S. mortgage funds to have the worst outflow showing this week for taxable mutual funds. All told, about $408 million was removed from mortgage funds. Again, 350 or so from double line. Another good showing this week was from FPA Crescent. FPACX has a couple of weeks now with $100 million plus inflows. They've definitely found a new audience out there for its product. Now, if we turn our attention to fixed income ETFs, we'll see that they took a little bit different approach. They had about $450 million in outflows this week. Not too many bright spots, though. Only short duration and international income products showed any inflow potential. Very, very light though. They did see more outflow attention given to the longer duration and inflation-related products. TLT certainly took the worst of it this week for fixed income ETFs. Next group to take a look at is municipal debt funds. They definitely had a rough go of it this week, although things have looked better. They had about $1 billion in outflows. They've had 7 consecutive weeks of outflows, and the market isn't helping things. They've had 6 out of 7 weeks down for them in terms of total return, which is going to keep a lot of investors at bay. The size of the category was directly related to the size of the outflows this week, so it would appear that investors were not making any real moves as far as second guessing where the municipal market might be headed. Instead, if they took it out in proportion to the assets, so no real direction there, in other words. The final group to take a look at is money market funds. Again, they had inflows this week of just under $23 billion. Institutional investors were responsible for more than 100% of that. They allocated about $23.7 billion this week to their cash accounts, while retail investors maybe found something to spend their money on. They had outflows of about $847 million for the week. Well, that'll wrap it up for this second week of July. Join us again next week where we'll report on the flows into into mutual funds and ETFs. I'm Jeff Turnahoy. Thanks for watching.